So what's most likely to cool Toronto's housing market right now? That's what we're going to be talking about today. My name is John Pasalis, president at Realosophy Realty. Catch all my latest writings on Toronto's housing market at movesmartly.com. And if you find this video helpful, please hit the like and subscribe button to stay up to date on all my latest videos. So of course, one of the most common questions I'm getting lately is what's likely to cool Toronto's housing market? It's unbelievably competitive as we start sort of the new year. So what factors might lead to a slight cool down? Now, when a lot of people ask me what's going to cool the housing market, they often, I find, mean like what's going to cause prices to fall. But before we kind of, put house prices in reverse, we have to think about what's going to actually cause sort of the housing market to actually slow down, not appreciate as quickly, to kind of slow down the pace, because that's typically what happens first before we see a decline in prices. And I really think there are three things that are likely going to lead to a cooling down in Toronto's housing market in 2022. And the first is, I'd say, buyer fatigue. I mean, and really fatigue from a lot of buyers in the housing market who are getting priced out of the housing market as house prices have exploded. Now, when we think about who are the buyers in the housing market, almost 50% are first-time home buyers. And among those first-time home buyers, one of the key things that they're looking for, like a significant number of these buyers, of course, are looking for sort of this traditional starter home, 3-bedroom home, of course, not necessarily detached, a semi or a row house is fine, but generally a low-rise family home. I mean, of course, some buyers are looking at condominiums, but young people starting a family generally aren't looking for 700 square foot condos. Most tend to be looking at low-rise homes. And among the low-rise homes that are out there, the most important price point is sort of this under $1 million price range, because under 1 million, you can buy a home with less than 20% down payment, with mortgage insurance through CMHC, for example. But if you're buying a home priced over 1 million, you would need to have 20% down. So this additional down payment requirement for homes that are over 1 million makes it harder for first-time home buyers to get into the market. Now, having said that, if we look at the number of homes that sold for under 1 million in the last quarter of 2020 compared to the last quarter of 2021, we can kind of see they've fallen significantly. Last quarter 4 of 2020, just over 8,000 homes sold for under $1 million. These are low-rise 3-bedroom homes. And last quarter in 2021 is just over 2,000. So it has become significantly harder to get a 3-bedroom low-rise home anywhere, and this is the entire Greater Toronto area. So this is certainly one factor that is pushing some buyers really outside of Toronto, leaving to smaller municipalities, or possibly just putting an end to their home search entirely. So I think buyer fatigue certainly is going to be one factor, which is, of course, coupled with the really, really high home prices that we're seeing. The second factor I think that's potentially going to cool the housing market is, at least we're hearing about the federal government potentially tightening credit on investment properties. And this is really something that the Prime Minister is asked to look into. And this would potentially involve increasing the down payment requirements from 20% to maybe 25 or 30 or 35%. And this, again, potentially can cool the housing market a fair bit by taking both some demand out of the market and potentially adding supply. Now, if down payment requirements go from 20 to 25%, it's not going to have a huge impact. If they go from 20 to 35, that is a huge impact. So not only is it going to make it harder for people who are going out and buying investment properties because they need an additional 15% down payment, but it's potentially adds to supply, because a lot of the investors in the market right now are not necessarily people who are going out, buying homes that are listed for sale, purchasing them and renting them. A lot of the investors are people who are buying their next home or upsizing and keeping their current home as an investment property, right? So that home actually never even hits the market because they've lived in it for 10 years, they've just moved out of it. But if you need significantly more equity in the home to hold onto it as an investment property, say 35%, well, this makes it a lot harder to do that. So increasing down payment requirements could definitely both cool demand and increase supply in the housing market. Now, the last thing I'd say is one thing that we've been hearing a lot about, of course, and that is rising interest rates. I mean, with inflation hitting the highest level it's been at since the 90s, there's a lot of pressure on the Bank of Canada to raise rates. And a lot of people are expecting interest rates by the end of this year to be up at least a full percentage point. And this is going to have a couple of factors. I mean, impacts. Number one, it might have a slight impact on how much people could afford in terms of affordability when they're getting a mortgage. Not a huge impact, because today people are qualifying at the stress test rate, which is at 5.25%. So even if rates go up 0.5% or 0.75%, it shouldn't have a very big impact on how much people could qualify for a mortgage. But where it should have a huge impact is how much debt people are willing to take on. So if we think about, if I qualify, for example, if I can afford an $800,000 mortgage today at 2.5%, well, if rates go up by a full percentage point by the end of the year, let's assume I still qualify for that same $800,000 mortgage. The difference is, at the higher interest rate, my mortgage payments have now gone up $400 a month, right? And the question will be, how many buyers can afford that additional mortgage payment, especially when we're in this inflationary environment where everything else is becoming more expensive. So I think we might end up seeing not just some buyers pulling out of the market, especially investors, as rates rise, but a lot of home buyers either saying, I can't afford this anymore because it's too expensive, or scaling back sort of how much they're willing to spend. So those are the three things that are most likely to kind of cool the housing market this year. Now, of course, a lot of this is going to depend on public policy. I mean, the Liberals, as part of their election campaign, had proposed increasing sort of the ceiling or the minimum for the CMHC insurance from 1 million to 1.25 million. So that would mean that, you know, basically you could buy a home with less than 20% down, potentially as high as 1.25 million, versus the 1 million today. Well, if the Liberals do that, that will just accelerate demand. Actually, it'll do the opposite of what I'm suggesting. It will actually accelerate demand, push home prices up higher, because it gives people far more access to debt and allows them to take on more debt with a lower down payment. So if the federal government does something like that, you know, we could see things accelerate as we move into the year. My instinct is they're not going to do that, because we already have a very competitive housing market. I suspect we're probably going to see these cooling trends, but again, it's very hard to predict because there are a lot of factors, but I suspect these are going to be the ones that we're going to see play out in the year ahead. Hope that makes sense. If you have any questions, feel free to post them below and send me an email at askjohn@movesmartly.com.